Welcome back, class, to our second segment of Chapter 10. We're going to talk about the market for corporate governance. We're going to talk about that for a few minutes. And when we're talking about the market for corporate governance, again, we're talking about when publicly traded companies loses value, it becomes a target for a takeover. So now we're starting to think about what's going to happen if we start to lose value in the corporation. And when you start to lose value in the corporation, then start to see these red flags and start to see tension will oftentimes start to develop, between the board of directors and the CEO, or maybe the entire executive management team or senior management team of a corporation. And when we talk about takeovers, there's several ways that can go about it. You can have a leveraged buyout. It's called an LBO. And it's when a company that is purchased through significant debt. So now we're talking about a leveraged buyout. So the money that, they're talking about going into debt to publish a company, that's where the term leveraged buyout comes into play. And leveraged buyout is publicly traded company is purchased and then taken off the stock market. So purchased, taken off the stock market. The LBO typically results in reduction in workforce, streamlined cuts, bringing in entrepreneurial spirit, especially in your management team. And depending on the corporation, depending on the industry, but in most cases, it can be an extremely stressful time for everybody associated with that corporation. Because again, leverage buyouts, you're going to have to go in there and turn that company around, and you've used debt to purchase the company. And so you're looking at ways to become more efficient. You're looking at ways to, again, reduce costs. You're looking at ways to somehow, can you grab some economies of scale? Can you drive that long run average cost down by adding, reducing cost, reducing either fixed or variable cost, increasing the number of units that you have? There's just a lot of tension as those in the executive management positions of these leveraged buyout companies are trying to turn things around and move the company forward. Takeovers tend to increase shareholder values, and a change in ownership tends to have a negative slant for the most part, especially when it comes to employees. It's just not, it's not, when you're talking about a takeover, a leveraged buyout, and I've been involved in some of them in the past, and it's just not a pleasant situation for a lot of those involved, especially if you're employed by the company that's being taken over. And the text does a pretty good job. I think I forgot to write the page down, but they do a pretty good job talking about takeover terminology. First one is a corporate raider, an individual or company that purchases stock in another company with the goal of an eventual, the eventual takeover. That movie, Pretty Woman, with Richard Gere and I'm drawing a blank on the gal's name, but that's what Richard Gere was in that, Pretty Woman. He was a corporate raider. He would go in, take over companies, tear them apart, sell pieces off. That's how he made his money. And he was extremely good at it. But Julia Roberts. So, but in the end, he kind of saw the light and he went from being a corporate raider to takeover, and a lot of his were hostile takeovers. And again, a hostile takeover is an attempt to purchase a company that is strongly resisted by the target company's CEO or board. And I guess it was what turned his life around was when he tried to take over. I want to say it was a shipping company on the West Coast. And it was like a father-son. But to me, it was an enjoyable movie, and it kind of gave you an idea of what could be happening in corporate America. But again, it gets really unsavory when you're talking about corporate raiders and hostile takeovers. And then the third piece of terminology the text talks about is shark repellent. and it's defenses against takeover attempts. So, and you hear shark, repellent, thrown around some. You listen to CNN, you listen to Fox Business News, and they're talking about not so. I don't hear corporate raiders much, but they'll talk about hostile takeovers. The fourth one's White Knight. I hardly ever hear that one mentioned, but it's a company that rescues a target company by offering a friendly takeover as an alternative to a hostile one. I know it happens, and there are a lot of examples out there, but it's just not something that you typically hear discussed by the talking heads on a lot of these business channels. One that I hadn't heard of was Green Mail. An unfriendly company forces a target company to repurchase a large block of stock at a premium to thwart a takeover attempt. That's I've never heard that term before, but I can remember reading some articles about it, and the concept I'm familiar with, but that green mail is a term. It's just not one I've heard of. I think a lot of us had heard about poison pill, and again, you hear that discussed when you're talking about business environment on. Again, I listen to Fox Business News. Some people use, CNN, ABC, CBS, NBC. There are a lot of, expert talking heads out there, and it just kind of depends on which one you enjoy listening to the most and which one you think provides the valuable information that is going to drive your financial risk forward. So, but they talk about a poison pill, and it's an attempt to make the company's stock unattractive to raiders by letting shareholders buy stock at a discount, which creates a conversion of equity to debt that makes the company less attractive. And you see that happens some. I mean, I've worked in the past for health plans that publicly traded, and they didn't talk about it as a poison pill, but we knew that there were other companies looking at taking over, and as a company employee, you could buy stock at sometimes a very attractive discount. A very attractive discount to the employees of the company. You'd have a lot of employees that would buy the stock. You've got a golden parachute, and that's one that you hear a lot about on TV. You read a lot about it in, the Wall Street Journal and a lot of your financial publications. It's a financial package, often including stock option and bonuses worth millions of bucks, given to executives likely to lose their jobs after a takeover. Every executive, and especially if you listen to head football coaches for the NFL, they will all talk about, head coaches in the NFL are hired to be fired. And they all have, buyouts and, these golden parachutes that they are going to make, even if you lose your job, not only did you make a lot of money while you were there, but you're going to receive a significant financial package not to work. I wish I were in a situation like that. I think a lot of Americans would like to be in a situation like that where you can actually make more money being fired than you can on the job. So a lot of times these golden parachutes impact the decisions of a corporation or impact the decisions of a particular company. And then the authors, so we've kind of gone from, corporate governance, market strategies, what the board, as far as roles are responsible for. And now the authors start to move into corporate ethics, social responsibility, and their definition of that, it's executive grapple with decisions that have ethical dimensions. And I think all executives grapple with that at one time or another. Laura Kohlberg suggests moral development has 6 stages. And I'll quickly go through this. I'm not sure that I agree with all of these 6 stages, but I've seen these 6 stages in on leadership classes, leadership textbooks, and seminars I've attended, and we'll kind of go through them. And again, academics putting information out there, trying to put their brand on it, their spin on it. This one has gotten, I guess, a fair amount of traction. But I want you at least to be familiar with it. But the 6 stages, And he kind of takes the 6 stages and divides them into 3 main stages. One is pre-conventional level of moral reasoning. Um, Egocentric in nature and moral reasoning is tied to personal concerns. Stage one focuses on the direct consequences of an individual's actions. Stage two, reward stage, or what's in it for me. Um, and so his rationale is moral development of especially executives of a firm moves kind of through these stages. In that first stage, it's, they're more concerned with what's the punishment if I get caught. And once they get past the issue with what's going to happen to me if I get caught, am I going to look, really good and in an orange jumpsuit, or, if I get sent to prison, is, my new best friend going to be Bubba, or just there's a lot of concerns with the punishment aspect in that first stage. And then it kind of morphs in, it goes from stage one on the pre-conventional, it kind of moves into stage two, and now we're talking about, okay, let's say I do something that's a little unethical and I don't get caught. Uh, that's the reward stage. What's in it for me at that point? So stage one and stage two, pre-conventional level of moral reasoning. And then stage three and four, we're talking about the conventional level of moral reasoning and comparing individuals' actions with expectations of society. What would society think of my actions if I were caught or if they knew about them? Stage three is basically conformity driven and act with the goal of fulfilling social roles. In other words, you've got executives that are concerned with filling social roles. Parents encourage children to be good. That's kind of stage three. And it's a similar concept with, you're talking about executives. They are, I guess, been trained to be good and trained to fulfill social roles. Stage four in the conventional level is the importance of obeying laws, social conventions, and other forms of authority. So as you're moving down through here, you're kind of developing your moral reasoning. And when you're talking about stage four, I think the example they gave in the textbook is people in a restaurant that constantly on their cell phones. I mean, some restaurants have actually gotten to the point that you go into a restaurant to eat dinner, you check your cell phone at the door. And I think that's a good idea because you're in a restaurant to eat dinner. It's a social environment. Don't be sitting there playing on your cell phone. Don't be texting back and forth. Don't be talking at it. That is really rude. And you see it a lot in European restaurants as people conducting business in a restaurant, and maybe they have their computers out working. It's just not a level of moral reasoning that I can just connect with. And then the third of Kohlberg's, I guess, overarching levels of moral reasoning is the post-conventional. Morality is more than for following social rules and norms. Stage five that falls into the post-conventional is considers different values and opinions. What can I do as a leader of an organization to ensure the value of the greater good, ensure the value of the greater good of society? So you're starting at this point in this third major stage, but stage five that falls into the post-conventional, you're starting to talk as an executive and think about different values and opinions. And then stage six is the universal ethical principles. Individuals have a duty to disobey unjust laws. That's where it kind of gets with these moral dilemmas on executives. If executives have individuals reporting to them, or executives see maybe at a horizontal linkage, maybe they see some of their peer groups starting to do things that are unethical, starting to implement unethical practices, starting to try to damage the brand and the reputation of the company, then they have a duty to disobey unjust laws. So I don't know. It gets really confusing. And what do executives within a corporation, especially the senior management team, how do they move from you know pre-conventional, conventional, post-conventional stages, and those five or those six stages that are allocated between those three. And so you see these moral dilemmas, these ethical dilemmas constantly among um, individuals within a corporation. And I can honestly say I've worked for some corporations in the past that some of the decisions they made and some of the policies and practices they put into place, I don't know, it makes you a little uncomfortable, but it's we'll just leave it at that. I've been made uncomfortable on more than one occasion. And then we get into and they spent a relatively let's say significant amount of time, but they talk about corporate scandals and Sarbanes-Oxley, and you'll hear people talk about SOX, S-O-X, and that is Sarbanes-Oxley. Enron was, if you remember, I can't even remember when it occurred. 20, I think it was after 2000 when Enron was caught, and it's kind of when you talk about scandals of corporation, it's kind of the poster child of corporations. There were some questionable accounting practices went on, and individuals that had invested their pension in the 401ks and freeing on the company, they lost it all. You've also got WorldCom, you had Tyco that kind of fell into that they didn't get the notoriety maybe that Enron did, but Enron is again the poster child of corporate scandal. And SOX, Sarbanes-Oxley, it's a law that set new or increased standards for boards of publicly traded U.S. companies and accounting firms. Again, publicly traded U.S. companies and accounting firms. Congress attempted to restore investment confidence, and it was, G.W. Bush in 2002. So SOX, Sarbanes-Oxley, so Enron must have been in the late 90s and early 2000s because GW implemented into law in 2002. And SOX, or Sarbanes-Oxley, has 11 aspects, and it was the most radical change when it came to the business world since FDR made some changes in the way that accounting firms and financial results were reported. And we'll kind of work through the 11. And again, the text does a very good job when it comes to working through this Sarbanes-Oxley. So I would definitely suggest you spend some time reading through the text. But the first one is oversight board to oversee audit activities. And so you're talking about somebody on the board of directors that is oversight of the audit activities. And a lot of the health plans I've worked for in the past would actually bring in, PricewaterhouseCoopers, I'll just, one of the accounting firms to come in and do, to oversee, and the board of directors oversee those audit activities. And you're bringing in an accounting firm that should have an unbiased view of your accounting activities. Number two was to ensure auditors are independent. Again, PwC that we bring in, auditors are independent and not subject to conflicts of interest. That's why a lot of the health plans I work for have gone outside to some of the big accounting firms and brought them in. Number three is senior executives must take personal responsibility for accuracy of financial statements. And so when they take responsibility for them, those financial statements, if you're an executive, especially the CFO or the CEO, you better be prepared to understand those financial records and be ready, because you're going to have to sign those documents. And at that point, you're putting your name on the line, you're accepting accountability, and you're accepting responsibility for the accuracy of those financial reports. Number 4 is enhanced reporting required for transparency of financial conditions. And again, this goes along with taking responsibility for those accuracy of those financial reports. Number 5, securities analysts must disclose potential conflicts of interest. So if you're doing analytical work and you're securities analyst and you have a conflict of interest with a company or with an organization that you are serving as a analyst for, you have to disclose that potential conflict of interest. Let's say you're a securities analyst and you own stock in a particular company that you are doing work for or actually analyzing. You have to disclose that so that it's complete transparency and everything's above board. Number 6, CEOs must personally sign. Again, they must personally sign the company's tax return to eliminate the claim of tax fraud. So they have to sign the tax return just like they have to sign those financial reports and be responsible for those financial reports and tax returns. Number 7, the SEC can censor or ban securities analysts from acting as brokers, advisors, and dealers. And the SEC, again, is the Security Exchange Commission. So they have the responsibility or the ability or the capability, whatever term you want to use, to censor or ban or bar, again, depending on what term you want to use, securities analysts from acting as brokers, advisors, and dealers in the stock market or in stock exchanges or the buying and selling of securities. Number 8, Comptroller General is required to monitor consolidations among public accounting companies, role of credit agencies in securing market operations, securities violations, and enforcement actions. And a lot of these are reports that the Comptroller General is required to monitor to ensure that everything is above board, there's complete transparency, and everything is moving forward in a positive direction. Number 9, criminal penalties exist for altering or destroying financial records. You would have thought those had been in place prior to that, but obviously not. Number 10, significant criminal penalties exist for white-collar crime. Again, 9 and 10, and even 11, when we get to it, it's SEC can freeze unusually large transactions if fraud is expected. You would have thought 9, 10, and 11 would have been in play before into law or into the legal regulations by GW, but those are kind of the big 3, and these now you're talking about the hammer. Criminal penalties, significant criminal penalties, especially if it's white collar, and you can freeze large transactions if fraud is expected. So there's your hammer. There's the hammer that SOX has and can bring forth on a corporation, especially a board of directors or the executive team, if they feel like that things are being managed in a way that is not transparent. After you read these 11, one of the first questions that I would have is, was anything in place on Wall Street prior to this? These seem, I realize nothing is perfect, but these seem to be really common sense. They seem to, I would ask the question is, why weren't they in place prior to this action, especially with Enron running amok and GW signing this into law in 2002. You've got, they talk about Bernie Madoff got 150 years in 2008, largest investor fraud ever. And, Bernie was even, I think at the time it all happened, he was even, chairman of NASDAQ, and that allowed to happen. You had Charles Ponzi in the 1920s and the Ponzi scheme. And, that's basically what Bernie was doing. So you might enjoy actually reading, go back to page 324 and 325 in the text and take a look at that. And then the authors from there, they start to move into corporate social performance, CSP. You also hear CSR, corporate social responsibility. So depending on which acronym you're listening to, social entrepreneurship is entrepreneurial actions where both economic and social value creation occurs. They talk about Tom's Shoes, where they provide. I can't remember all Tom's Shoes. May have been a free pair of shoes for every pair sold. Is it Bongo? Not Bongo. There's an outfit that advertises on TV that for every pair of socks they sell, they donate a pair of socks to shelters. You also hear companies, same thing with underwear and T-shirts, because they're pitching that their company is bettering both business and society at the same time. The more profitable they are, the more successful they are at selling merchandise, the more they're going to donate, and the more it's going to increase the social well-being of society in general. And it's called corporate social performance, the degree to which a company's actions honor ethical values that respect individuals, communities, and the natural environment. It drives in addition to creating economic value. Again, tying social responsibility, maximizing the social impact on the community at large, and tying it back to economic value of the company and their ability to sell goods and services. You've got, they mention a place in the text about Portland, Oregon Public House. All net proceeds go to charities. In a 3-year period, they donated $100,000 to charity. I'm an economist. I'm sitting there thinking, okay, 3 years they've only donated $100,000 to charity, so that's what 33 and a third, each year. Wonder how they're calculating on net proceeds. That if you're a public house and you have a lot of microbreweries in Oregon, especially in that Portland area, I don't know. I'm just wondering about. I like the idea of the donation. I'm just wondering how 3 years it's only $100,000 if you're donating all of the net proceeds. How's it calculated? Then you had a group, Kendra Lindberg and Adomini, KLD, subjectively. So they're a group of consultants that subjectively measure CSP and reports metrics of publicly traded companies. And it's, they also have a Adomini social investment firm that you can invest money in. And then when you're talking about the metrics of CSP, you're talking about community strengths, you're talking about product quality and safety, you're talking about employee relations, you're talking about environmental, talking about diversity, talking about corporate governance. All of these metrics are kind of tied together in trying to measure, CSP, and it from a business and financial perspective, CSP is important, and you have a lot of investors that focus on not only CSP but CSR. So that's one thing that KLD has done, and they develop these metrics and they report them on publicly traded firms. Understanding, and then at this point, we're going to stop for a few minutes, and when we come back, we're going to try to understand thought patterns because it is a key to corporate leadership. Talk to everybody in a few minutes.